All right, greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. So, there is an options trading strategy that I've been using over the last month or so that has worked out quite perfectly thus far, and I have not lost on a trade. So, I primarily do in terms of options trading, I primarily do, I buy calls, buy long dated call options, leaps, long-term equity anticipation securities. So I buy deep in the money call options. I also sell cash security puts, and also at times naked put options as well. And then I do vertical credit spreads, right? But the strategy that I've been using over the last month or so that has been working out perfectly for me is the diagonal calendar spread. The diagonal calendar spread, right? So I've been primarily doing this on, your more expensive stocks. So and also the indexes. So for example, like the RUT, I've been doing this on over the last 30 days. As you can see here, I made over the last 30 days, $718 just on trading this diagonal calendar spread on just the RUT. And I've also been doing it on Meta as well. So here I made over $1,000 over the last 30 days on just Meta on Meta alone. So just Meta, RUT. I've been implementing this strategy on Avgo, AVGO, which is Broadcom. And so so the trade has worked out perfectly, at least thus far, right? Nothing is 100% guaranteed to work all the time in the world of trading. But so here's what I do. So for the RUT, for example, I look to put on the short strike, right? Because it's a spread, right? It's like the vertical credit spread, but it's a diagonal calendar spread in the sense that you are placing a short strike and a long strike on different expiration dates. So for the short strike, I like to go out no more than 7 days. So between 7 and 14 days. So for example, now the market is closed right now. So for example, if we're looking at the expiration date of December the 29th, right? I'm looking to place my short strike because my short strike is my income engine, right? That's my income engine. So I don't want to go too far away from the price of the underlying. And so I'm looking to go to a delta around between 15 and 30. So the sweet spot is like 20. So I'll go and place my short strike at a delta of 20 or around 20. So in this case, it would be 24.85. And then my long strike, I'm looking to go out around 45 to 60 days, right? Because my long strike is going to provide security in the event that the price of RUT should happen to drop and drop rapidly. Right. So on my long strike, let's say I go out to February the 20th, and I'm looking to go to a delta that's slightly higher or slightly greater than my delta for my short strike. So let's say 22. Now, as you can see here, my overall delta is going to be slightly negative, right? So it's a slightly bearish position. And that's what I want. I want my delta to be slightly negative. Why? Well, because I want to take advantage of the possibility that RUT may drop in value. And so what I've been noticing is that, so as you can see the position here, right? So my short strike is at December the 29th. So that's 8 days from today. And my long strike is at February the 20th of next year, which is 60 days from today. And so that long strike is going to lose value much slower than my short strike, right? So when I teach my Flip That Option members, um, about this diagonal calendar spread. And when I'm talking about options in general, I always use the analogy of melting ice cubes, right? So we are selling and buying melting ice cubes. That's what options are. Options lose value over time. Just like an ice cube, over time, it melts, right? So my ice cube, right? My melting ice cube at the expiration date of December the 29th is going to melt a lot quicker, right? My short strike, than the ice cube that I bought for the expiration date of February the 20th, right? So my intention of putting on this trade is that I'm looking to acquire income. This is my income engine here. Why? Because this short strike that I sold is going to lose value much quicker than the long strike that I bought. Thus, when I close out the position for roughly 40 to 50% of the credit, 40 or 50% of the increase in the P&L, because this is actually a debit strategy, right? So you actually have to pay money out when you put this diagonal calendar spread on. And I primarily like to do this on the put side. So because my short strike is going to melt, this ice cube is going to melt a lot quicker than my long strike, I'm able to close this trade out for a profit. And also, I also have the option of rolling this short strike to a new expiration date for additional credit. Why? Because my long strike has quite a bit of time value on that will not melt or will not lose value as quickly as the short strikes. So I say all that to say that this diagonal calendar spread has been working out perfectly for me. So it's been my go-to strategy over the last several weeks, really the last month to 6 weeks or so. And now I will sometimes put on an opposing vertical credit spread on the call side. Just as it depends on what the market is presenting to me in terms of opportunity, right? So I may put on a vertical credit spread on the call side, but on the put side, because the credits have a tendency to be slightly more inflated on the put side versus the call side, my preference is to implement this diagonal calendar spread on the put side. So now before I put the trade on, before I put the diagonal calendar spread trade on, I'll come to this website here, optionsprofitcalculator.com. I'll click on diagonal spread, and essentially I will go in here and type in the underline that I'm looking to implement the diagonal spread on. That'll pull up the price, and then you can actually come in here and just type in your the information for the position that you're looking to put on. So for example, if we go back to the example that I brought up here, so for December the 29th, which is 8 days of expiration, 8 days until expiration, the strike is 24.85 on the put side, right? So that's the one we're going to write or we're going to sell. So here's that one. So December the 29th, 24.85 on the put side. That's the one we're buying. I'm sorry, the one we're selling, not buying. We're selling that one. And then the one that we are buying, going back, is 23.90, right, for the expiration date of February the 20th. All right, so we go back, type in. So that's the one we're buying. So February the 20th, 23.90, right, and then we hit calculate. And what this is going to do is it's going to show us in terms of, it's going to give us a price range, right, for the RUT. It's going to give us the days to expiration for the short strike. and it's going to show us where we're going to be profitable in terms of where the RUT's price is, right? And also looking at whatever day to expiration you're on. So this here is a good way to determine, you know, where you need to be in terms of price for the RUT, and also in terms of the expiration date within that the duration of your expiration time, to see where where you have to be in order to be profitable and what your profit should be around. So it's not exact, but it gives you a good idea. So this is a really good website that I've been using before I actually implement the diagonal calendar spread. So hopefully that was helpful. Again, this has been my go-to strategy over the last 4 weeks to 6 weeks, and I have not lost on a trade yet. So hopefully this was helpful. If you haven't already, please subscribe to the channel, and also like the video. Peace.